the ever-evolving landscape of global geopolitics, investors often find themselves grappling with unprecedented challenges, and few challenges are as pressing and emotionally challenging as the complexities surrounding times of war. As the world witnesses the unfolding events of the 2023 Hamas-Israel conflict, financial markets are characterized by uncertainty, prompting many investors to reassess their strategies in the face of geopolitical turbulence. So in this video I discuss how investors best maneuver the fine line between war and investment, and I try to help you understand the immediate impact of wars on stock markets around the world by looking at some historical precedents and how you can apply the lessons learned from these past events to the current geopolitical landscape. Alright, as always, I have prepared a little presentation. How do you best invest during times of war? So here's the table of contents. First of all, I want to reflect on the current geopolitical environment and what investors maybe should place emphasis on and what not. This kind of is tied to the second part of this video. How do investors best behave and position themselves in this environment? We will then take a brief look at what Warren Buffett had to say during the 2018 Berkshire Hathaway shareholder meeting about his World War II experience. And again, he emphasizes what US investors should learn from these past horrific events. And finally, I will actually take a look at some historical data. So how did stock markets behave during times of war? What kind of stock drawdowns can investors expect? When will recoveries take place? And so on and so forth. And so without further ado, let's jump right into it. First of all, by reflecting on the current geopolitical climate. Obviously, what is happening in Israel and Gaza right now is absolutely terrible. I want to be right up front about this, but this shouldn't really be the focus of today's video. I want to focus on the investing side of things, and I came across this tweet here on Twitter this morning, and let me just read that tweet to you. So here the Twitter user Raging Ventures wrote, "Let's assume Iran had a quote-unquote hint as to what Hamas might do this week. In brackets, likely. Let's further assume that Iran might have chatted with Russia and either Iran or Russia likely chatted with China. I would further highlight that Israel bombed Syrian, indirectly Russian-backed targets today. Aren't we now effectively in a two-front war? What if this is 1939 and the probability of China making a move in the Pacific has just materially increased? Are US investors, quote-unquote, really considering this possibility? In brackets, not likely. I've studied a lot of World War II history, but not a lot of financial history outside of the Great Depression during that period. How does one best position for the potential risk of a hot war, both as an investor and a citizen?" Now, I have decided to include this tweet in this video because I think at first everything that is said here seems to make a lot of sense. And I think many investors, when they watch the news with their family maybe or scroll their Twitter feed, they will come across a lot of negative news. And obviously people are worried considering all of these cruel images and, as expressed in this tweet, the worries of this conflict escalating to a broader scale. I think that's ultimately what makes us human, but also what makes us ultimately bad investors. Because as investors, we tend to overemphasize short-term developments and crises and overstress the impact on businesses all around the world and thus stock markets. And I would even argue that in this particular tweet, the Twitter user is using some fear-mongering tactics. So I'm not sure if that is his or her intention, but by just reading it, you get absolutely worried. And basically you are almost expecting World War III, which I think is an exaggeration. So what I wanted to remind you of with this chart here is, what we can see here is the long-term performance of different asset classes, and JP Morgan actually also looked at the performance of the average retail investor. As we can see, the average retail investor performs quite poorly. And why is that? Well, that's because first and foremost, many retail investors tend to act emotionally, irrationally when they shouldn't. And that's mainly because of emotions such as fear and greed. And in an environment of war or at least geopolitical tension, obviously we tend to act emotional because we are worried. but that's how you actually end up with poor results. So what should you do instead? Well, let me once again emphasize what you maybe should not do. I included a couple of screenshots that I took from the comments below the tweet that I have just shown you. And what people are basically recommending here is something I would absolutely not support. Of course, what the people here are basically recommending are short-term trades. And as you know, this channel is all about successful long-term investing. So I'm not recommending to get into commodities like oil or gold, which I think ultimately are terrible long-term assets. I'm not recommending to play the market by using put options as recommended by Jason Miller here. I'm not recommending to increase your cash position because then you are ultimately just trying to time the market. I want you to keep a long-term focus and to continue to look at how the businesses in your portfolio develop on a fundamental level. What I also don't want you to do is to try to become a military forecaster. You're an investor and you should stick to what you are good at. There's this famous quote which says there are actually only two types of forecasters: those who don't know and those who don't know that they don't know. And what I will say is that in the world, unfortunately, there are always things to worry about. Sometimes there may be a pandemic, maybe there is geopolitical tension, maybe there is some kind of economic instability. And obviously people naturally prefer certainty, and that this is particularly true for almost every stock market participant. So times of uncertainty can actually create opportunities, and I think that is something that you have to internalize, this mindset that uncertainty tends to create opportunities. And I would say in times of uncertainty, you have to be even more aware of what's going on in the markets and whether due to the short-term uncertainty, there may be opportunities for you to take a closer look at. I've decided to include a quote from David Raman here. He wrote, "Psychologists have demonstrated that the vaguer and the more complex a situation, the more we rely on other people, both for clarification and as touchstones for our own use. This helps us reduce our uncertainty toward our own beliefs." And I would argue that in stock markets, this is true too. So I'm sure many of you will have heard of the so-called herd mentality. People will just look what other market participants are doing. If a lot of people are selling, this is kind of a reinforcing cycle that you don't want to be part of. All right, as I said, let's have a look at what Warren Buffett himself had actually to say about investing during times of war. During the 2018 Berkshire Hathaway shareholder meeting, he was sharing his experience during World War II, where he actually bought his first stock when he was just 11 years old. I'm going to show you a little clip from that Berkshire Hathaway meeting in just a second, but what he was basically doing is he started by showing the audience I think it was 3 newspaper headlines. So we are in World War II, and Buffett was stressing that things weren't looking very good for the United States, and the headlines were much worse than some of the headlines we are seeing right now. Even though I have to say that the pictures probably don't get much more brutal than the ones that we have seen in Israel more recently. But here you have one newspaper headline from March 8th, 1942, and one from the next day. And there's actually a great article that kind of summarizes this Berkshire Hathaway meeting, or at least that introductory talk by Buffett. Let me just read what is written in this article. Here it says, Buffett had his sights on Cities Service, which is a stock, preferred stock, which was trading at $84 the previous year and had declined to $55 a share in January. And now on March 10th, we just saw the headlines from that day, it was selling at $40 a share. That night, 11-year-old Buffett decided it was a good time to invest. As Buffett recounted, despite these headlines, I said to my dad, I think I'd like to pull the trigger and I'd like you to buy me 3 shares of City Service Preferred the next day. And that was all I had. I mean, that was my capital accumulated over the previous 5 years or thereabouts. And so my dad the next morning bought 3 shares. The following day was not a good one for the markets. The Dow broke 100 to the downside, sliding 2.28 points. And later in his talk, Buffett actually included this chart here, which showed where exactly Buffett was buying his 3 shares of Cities Service. As you can see, even back then, Buffett didn't possess the ability to time the bottom of the market, although one has to say his timing was quite good. Later in the talk, he actually points out that he sold Citi's service way too soon. I think he sold it at a profit of around $5 a share. And as you can see, if you zoom out over the next, 4 years or so, the stock basically quadrupled. Again, this kind of shows that short-term uncertainty can create opportunities if you can remain your long-term outlook. And that is something that actually Buffett also later stresses during his Berkshire Hathaway speech. So let me just show you a short excerpt from that 2018 meeting.
Profit. Well, what's the point of all this? Well, we can leave behind the city service story. I would like you to again imagine yourself back on March 11th of 1942. As I say, things were looking bad in the European theater as well as what was going on in the Pacific. But we were going to win the war. And if you'll turn to the next slide, I'd like you to imagine that at that time, you had invested $10,000 and you'd put that money in an index fund. We didn't have index funds then, but you in effect bought the S&P 500. Now I would like you to think a while, and do not change the slide here for a minute. I'd like you to think about how much that $10,000 would now be worth if you just had one basic premise, just like in buying a farm, you buy it to hold throughout your lifetime and you look to the output of the farm to determine whether you made a wise investment. You look to the output of the apartment house to decide whether you made a wise investment if you buy an small apartment house to hold for your life. I want you to think how much money you might have now. And now that you've got a number in your head, let's go to the next slide and we'll get the answer. You'd have $51 million. All you had to do was figure that America was going to do well over time, that we would overcome the current difficulties, and that if America did well, American business would do well.
All right, so once again, I want to emphasize that what you as an investor have to do is you have to continue to track what the impact of any geopolitical tensions or conflicts is on your particular businesses. Like for example, this morning I read that NVIDIA CEO Jensen Huang actually published a letter because a dear friend of him has actually lost his daughter during the brutal attacks on Israel. So he wrote, "It is with a heavy heart that I share with you the news of our loss. My dear friend Eyal Waldman, the CEO and founder of Mellanox, which was acquired by NVIDIA, lost his daughter." And what I also read later this day is that actually around 400 NVIDIA employees were now drafted to fight for the Israeli army. And obviously that is going to have an impact on the business. I think that's around 1.5% of the total workforce at NVIDIA. But I'm not an NVIDIA shareholder, but even if I were one, this wouldn't really worry me because NVIDIA's services and products offered are really impacted by this war. NVIDIA is operating at a global scale, very diversified in terms of the geographies where they operate. Yeah, I think you get the point. Like another example I can provide you here is I'm a shareholder in the company Wix, which is basically a website builder, and Wix is headquartered in Israel. And obviously I have considered to what extent the business might be affected. There is some increased risk of the business being affected, right? Because Israelis basically being attacked by hundreds of rockets each day. And the Iron Dome is obviously doing everything it can to protect Israeli citizens. But still, I'm a bit worried about it, but it's still not a reason to sell that business. I always like to adopt the mindset of a business owner. And if I would own the entire Wix corporation, I would not sell it to someone else right now just because of the atrocities that were occurring more recently. All right, to wrap it up here, let's have a look at some historical data. How did stock markets behave during times of war in the past? I've actually brought a couple of charts here that I want to discuss. So what you can see here is basically the performance of the S&P 500 ever since Russia decided to invade Ukraine. And what you can see here is that we are pretty much break even. In the month that immediately followed the invasion, the S&P was actually declining, but I think there were other factors at play here too. Inflation, if I recall correctly, was still very high, and it was still uncertain whether the Fed could get inflation under control. Then in this chart here, you can basically see the performance of the Dow Jones right after various military conflicts. In dark blue, you can see where the Dow Jones was sitting at 6 months after the onset of the military conflict, and in light blue, where the Dow Jones was 1 year later. And as you can see, and I think that's actually quite interesting and surprising, stock markets do not react as much on military conflicts as one might expect. So the maximum drawdown was right after World War I, which was almost 30%. Just for context, I think during the pandemic, we had a drop of almost 30% within 2, 3, 4, 5 weeks. And after the onset of the other military conflicts, we barely noticed any significant decline over the course of the next 6 to 12 months. All right, what we can see here is once again a list of various global geopolitical events. And I've actually highlighted 2 columns in this table. One, the total drawdown following the event, and on average the decline was only 5%, which once again emphasized what I just said. On average, stock markets tend to be quite, I'll put it in inverted commas, immune to military events. Like a decline of 5% is pretty insignificant in the broader scheme of things. And we can also see how long it took stock markets on average to recover, and on average it took markets 47 days. And maybe I should say markets, what this table was looking at is the performance of the S&P 500 specifically. All right, and finally, here's another table which basically shows you if you can continue to maintain a long-term outlook. Stock markets are the asset class to be invested in, so not oil, not gold, not other commodities or any option plays. No, if you can keep a long-term investing horizon, you're almost guaranteed to gain real purchasing power. For example, over 10-year rolling time periods, investors saw a positive return 9 out of 10 times. And if you can extend that time horizon to 20 years, investors never lost money. And I think we can wrap it up with that. Let me know what you think about the current environment and how you position your portfolio. Take care and see you in my next videos.